everybody. Well, thank you so much for joining us today. I am Tricia Meyer. I'm the founder and managing attorney at Meyer Law, and I'm co-founder at The Clever Baby. And I'm so excited to be here today with this powerhouse panel of investors that are here to help you understand what they look for in investments, how to find investors, how they assess companies, common challenges that companies face when raising money, and so much more. Our first panelist is Elisa Miller-Out. She is the managing partner at Chloe Capital. Elisa and I met years ago in Chicago. She is such an amazing, driven person. She is such a force, and I'm so excited she's here. Elisa, welcome. Please share a few words about Chloe Capital and your background.
Absolutely. Thank you so much, Trish. So I'm Elisa Miller-Out, managing partner at Chloe Capital. I'm based in Ithaca, New York, and our headquarters office is here, and founded the firm back in 2017. My background is as a tech entrepreneur, as an investor. I'm also a mother. I have two amazing daughters and two dogs who are my only sons. My award-winning innovation ecosystem building work was one of the things that led to the formation of Chloe Capital. And my early career included over a decade as a CEO and co-founder on a global software services firm with multiple software product spin-outs as well. I've personally founded 7 companies. I've built a portfolio of 65 companies and have overseen about a dozen M&A transactions across that, including a $100 million exit recently. And I also advise New York State on an $800 million portfolio of climate tech investments and programs for the in their NYSERDA division. And then I also serve as a mentor with the National Science Foundation and an entrepreneur in residence with Cornell University. Chloe Capital, of course, is a movement-driven venture capital firm investing with a mission of inclusive ecosystem building at scale. And we also operate accelerators, and we're in over a dozen cities around the US. I'll pause there. Thanks so much.
Oh my gosh, amazing, amazing. You have so much going on, so much goodness there for sure. Next up is Desiree Vargas Wrigley. Desiree is the Chief Innovation Officer of P33, Executive Director at TechRise, and co-founder at the Josephine Collective. Desiree and I go way back. We met in 2010-ish, I think, at an event at the Merchandise Mart through a mutual connection, and the rest is history from there. I am so excited Desiree was able to join because she is also an entrepreneur like Elisa, and she can also give guidance from both, that perspective and the investor perspective. Not to mention, she is fabulous. So Desiree, please share a few words about your different roles and your background.
Well, Elisa's a tough act to follow, but I will do my best. Tricia, it's great to see you, and congrats on the growth of the firm. It's grown so much since we first met. But yes, I am a Latina, two-time Latina founder here in Chicago turned funder. My first 2 startups, the first one, Give Forward, was, I think, the first peer-to-peer crowdfunding platform in the world. We were before Kickstarter, Indiegogo, definitely before GoFundMe. Now it's a part of GoFundMe and help people raise about $200 million on that platform. Then built a company called Parachute, the kids activity marketplace that you might have seen us on Shark Tank. We got the second biggest deal at the time with Mark Cuban in 2017. So some great founder experience, especially building in categories that are traditionally hard to fund, which is part of the reason that I joined P33. After the murder of George Floyd, I just realized that having raised from firms like First Round Capital and Founder Collective, I'd gotten to see what it was like to be part of coastal portfolios. And the Midwest was really missing a lot of support for our founders, especially my fellow Latino founders and BIPOC founders. So came here and built something called TechRise, which is non-dilutive funding for overlooked founders across a variety of industries and across the entire state of Illinois. We've helped founders, about 300 founders, with about 2.5 million in non-dilutive grants, which is not that much, but they've gone on to raise $110 million in about 2.5 years in follow-on funding, up from just 9 million in 2019. So definitely have seen the power of a collaborative and inclusive, intentional growth in our ecosystem. And Chicago is now the best city in the country in terms of a percentage of early stage capital going to BIPOC and women founders. And I now also run something called the Josephine Collective, which is designed to try to bring more women and people of color into the asset class by giving them access and kind of smaller scale checks so that we can come in on the cap table all together. And then the last project is still kind of in stealth, but it's not so stealth. And that is that I'm launching a new hyper-regional hybrid fund to support Illinois' emerging fund managers and our pre-seed startups in industries that are critical to the Midwest. So it's one of the first of its kind. I'm pretty excited to experiment with this incredible model.
Oh my God, that's so amazing. Again, so much going on. I don't know how you find time for everything. Oh
I
my
also have
God.
my family thing too. I'm also a mother, 2 boys, and then I have a
Yes.
stepdaughter, and then I do have a girl dog also, and a lovely husband.
Yes. So, oh my gosh, getting it all in there. Yes, that's so amazing. Next up is Peter Adams. Peter is the managing partner at Rockies Venture Fund. He's the interim executive director at Rockies Venture Club. He's the managing partner at the Pandemic Impact Fund, the Rockies Vintage Fund, and the Rockies BIPOC Fund. I met Peter very soon after we launched our office in Denver in 2013, and we collaborate whenever we can. The last time we talked, he was sailing the seas. So, Peter, let us know where you're at now, and please share a few words about your background.
All right. Well, speaking of backgrounds, I'll just share with you. I am actually sailing the seas, so this is a good place to be, and doing it by Zoom every day. Although shifted a little bit, to fit the time zones, which is quite a bit off. So I'm going to turn this off because I'm going to make you seasick. Take you back. But just some quick stuff about what we're doing here. So Rockies Venture Club is arguably one of the oldest angel investing groups in the country. We've been around for 39 years and have gone through a lot of iterations and changes throughout that time. And on that platform, we've built the Rockies Venture Institute, and then the Rockies Venture Funds, and then programs like the Angel Capital Summit coming up next week. So lots and lots of events. We do over 100 events every year, and those include our Hyper Accelerator programs, where we take what is usually a 12-week program and cram it into 1 week. And so it's just a super intensive program. We do lots of different flavors of the Hyper Accelerator. So the EDA has been supporting us with the BIPOC Hyper Accelerator for underserved founders. And then we've done, life science hyper accelerators. We've done OEDIT, which is Colorado's Office of Economic Development. We do economic development hyper accelerators and so on. So it's a lot of fun. We do about 4 of them a year, which is a lot for us. And then we're doing a lot of things where the investment is not as easy as it is, say, in Silicon Valley or running a regular fund. And there's something about me, I think, that I just like pursuing a challenge. So, of course, things like the Rockies Seed Fund, which is a BIPOC fund. That's its mission, is investing primarily in Black and Hispanic founders. And then we've got the Rockies Wyoming Fund, which is actually one of the first private funds in the state of Wyoming. So there's only 600 or so thousand people in Wyoming, 0 funds, and that's something we're going to be changing. So that'll be really fun, but it's definitely ecosystem building because there's not sort of all of the normal models for founders to look at and model themselves after those successful people have gone before them. And as if that weren't hard enough, now that I'm sailing in the Eastern European seas, I spent last year in Montenegro and joined up with Digital Den, which is a startup studio there. And then we formed the Balkan Tech Fund with the mission to invest in companies from the 6 Balkan countries of Serbia, Bosnia-Herzegovina, Montenegro, Kosovo, North Macedonia, and Albania. And these countries total about 17 million residents, and Montenegro specifically is just about the size of Wyoming at 650, with almost 0 startup ecosystem there. So just truly building it from ground up. And I'll stop here and let us start with their panel. But I'll say that one of the most exciting things with being at this early stage is creating a set of values and a culture of startups helping each other, investors helping each other, and everybody working collaboratively to build this ecosystem. Even when there aren't large corporates to support this and the government barely has any money itself, it's a challenge, but it's things that we have to do, and we've seen that be successful in other ecosystems. So just as much as teaching people how to be startups and investors how to invest, we got to build those values and collaboration into it.
I love it. It's so amazing, and it's so You're just creating so much opportunity for people and allowing them to create the solid framework that they need to start up and grow. So I love it so much. You're doing so much and you're making such a difference. All of you are. I love that. Okay, and then last panelist, and certainly not least, Melody Ashby is here from Meyer Law. Melody is an absolute rock star. She regularly helps companies prepare to raise money and helps them throughout the transaction. And so I am so lucky that she's been by my side for 12 years. She is the absolute best. Melody, please share a few words about your background.
Hi, everyone. So my name's Melody Ashby, senior attorney. I've been practicing now for about 16 years, 12 of which, as Trish mentioned, has been with Meyer Law. Have had the privilege of assisting clients navigating the legal landscape of business transactions. Throughout my career, I've just been dedicated to providing that strategic counsel, tailored solutions to businesses of all sizes, from startups to larger organizations, really specializing in corporate fundraising, IP, and contracts. Super passionate about helping business owners achieve their goals and overcome those legal challenges effectively and hopefully efficiently. And just looking forward to this panel and connecting with everyone, sharing insights and expertise. Thanks for welcoming me.
Thanks, Melody. Awesome, you guys. Well, super excited to have you all here. I appreciate your time. I know how valuable it is. So let's get into it. Let's talk about each of you. If you could explain the types of companies that you invest in. Elisa, we'll start with you.
Wonderful. Thanks, Trish. In terms of the types of companies we invest in, first and foremost, at a high level, we have something called the founder to funder model. So what that means is we're looking for founders who will go through their entrepreneurial journey, and as they succeed and as they achieve those large multi-million and multi-billion-dollar exits, they will turn around and fund the next generation of underrepresented founders. So when we think about that founder to funder journey, we're really looking for those founders that are those ecosystem builders, that are already mentoring others, that are already uplifting other founders in their community, even while they're in the process of building their companies, right? So that's one kind of high level thing we're looking for in those types of founders. And then in terms of tactically speaking, our thesis, we invest with a gender and diversity lens, first and foremost. We invest at the seed stage primarily. We invest across the US and can invest about up to 30% of our fund globally as well. Some of the industries that we focus on include climate tech, as well as health, education and workforce, and fintech. Technology focus-wise, we focus on enterprise SaaS primarily. In terms of our check sizes, it's anywhere from 100 to 250,000 initially, and then we reserve for follow-on as well. And then in terms of our deal leadership, we mostly follow on deals, but we do occasionally lead as well. So hopefully that gives a little bit of an overview, and I'll pass it on to some of my other panelists.
Perfect. Desiree.
Yes. So wearing a couple different hats for TechRise, we focus on founders who've raised less than $2 million, and we have a variety of themes. So it really depends on who our sponsors and partners are for each competition. And you do have to be headquartered in Illinois or have a really strong connection, like you grew up here and still have family here and somehow are still investing in our state. When it comes to Josephine Collective, we invest all over the country. We'll invest at any stage. We'll go early and we'll go late. It's really about adding diversity to cap tables and then also making sure that we have access to great deals. We don't just invest in women, we just invest in great companies. Although I will say that 100% of our investments have had at least one person of color or a woman co-founder or founder. We are primarily investing in consumer. We do consumer products and consumer packaged goods. We do a lot in health, a little bit in AI, definitely some fintech. We're kind of all over the map on that one. Harder ones for us are manufacturing, real estate, and some of the deep sciences. But we have great partners to introduce you to for others. And those checks tend to be somewhere between $25,000 and $125,000, depending on the interest of the group. We also do kind of blind interest-based investing. So we don't have groupthink in our deals, which means that you might only have 10 angels in, or you might have 50 angels. It just depends on how much your deal resonates. And you can apply anytime at joinjosephine.com, and we'll get you through the pipeline.
Oh, that's great. Nice, efficient approach there. All right, Peter.
All right. So we're also in the seed stage, in pre-seed stage. So we're looking at companies who are actually horizontal in their markets. So we look at life sciences, we look at tech, we look at CPG, We look at a lot of clean tech, and now we're looking at aerospace. So pretty much anything that makes sense is something that we'll invest in. So that's driven by either the fund theses that we have, like the aerospace fund, of course, is doing aerospace, or the Balkan Tech Fund is, of course, investing geographically, or the Rockies Seed Fund is investing by BIPOC founders. And so the whole idea here is looking at all industries, and then having the funds have the expertise and what they are going to invest in. The club, Rockies Venture Club, is also investing alongside the funds. And that works a lot, sort of like Desiree's thing, with where we have people jumping into SPVs. It could be 4 people, it could be 40, could grow. I think our biggest has maybe almost 100 people in it, and that's just based on how popular it is. Our checks are going to be anywhere from 100K to 350K for a first round, and then our average investment will have as many as 3 or 4 rounds, and as much as, I think our biggest is maybe nine rounds of investment. We just did a Series H investment, which is kind of not a part of the alphabet that you see pre-seed investors playing in very much, but that one's doing very well. So we keep on going, and we had new investors as of last December in that deal. So that works. I guess I'll save the rest of my answers for the more detailed questions.
Yeah. Okay. And how do you find the companies that you invest in, or how do they find you? Desiree.
I have to correct myself. We actually have 3 manufacturing startups in our portfolio. So I guess we do. We just don't do like, really big, capital intensive manufacturing. But so we find our startups through a couple of different channels. One is here at P33, we've built something called the Common App, which is exactly like it sounds. It's a single point of entry for any startup to access capital sources across our ecosystem. And we welcome investors from across the nation into it. So you can find it at gotechchicago.com/the Common App, or just Google the Common App P33. You'll find it that way. And then the Josephine Collective also gets direct deal flow through our website, and then the relationships that we've built over time. But honestly, a lot of it comes from fellow founders who understand how we write checks and want to, be part of the change that's happening across, I think, so many ecosystems, including Chicago. So really try to open up the funnel as much as possible to welcome as many founders in. I will say for TechRise, we do a lot of LinkedIn sourcing and go and try to find founders who are in stealth, because that is a friends and family and pre-seed stage fund, which means often founders are moonlighting. And we do that based on theme. So that one's a little bit more proactive.
Yeah. Okay, great. What about you, Peter?
So we get deals from a lot of different places, and I will say the best deals that we see come from our own investors, because they've been there, they've watched other investors make decisions, they've been in the room, watched how we pick apart a deal and what we like and what we don't. And when they bring something in, it's most likely to be successful. So that's obviously a really great place. But when I think about startup ecosystems, they're at once broad, because now we have so many players in the ecosystem compared to like when I started my first business in the early 80s. There was nothing. There was Chamber of Commerce, and that was it, and that was not very helpful. So we are out there working with like federal labs like NREL, National Renewable Energy Labs, for clean tech deals, and the Colorado Clean Tech Industry Association. We're working with groups like Colorado Bioscience Association for our life science deals. We're working with all kinds of different accelerators for different different either racial or geographic areas. And then we've been around for 39 years, so we have attorneys and CPAs, and actually nowadays just all of these lists that we are on, that we're getting just unsolicited deals. And I'll just say, because this is something that's of interest to founders, those are in the tiers, the ones that just come in blind off of some list. They're not the best deals. And often I get like 4 of the same email from the same company. This happens almost every day, where it's to different people at Rockies Venture Club, and they all go to my sort of catch-all folder, and I know they're just spamming every investor out there. So if you're thinking of investing that way or raising capital that way, that's probably not your best thing. I almost never respond to those, but I almost always respond to a warm introduction. And so warm introductions are the best. And in fact, I get a lot of warm introductions from Meyer Law, so thank you guys. But it's really a nice way. They will play it. They will send it to me and say, "Hey, is this something that's looks good to you?" And if it does, I'll say yes. And if it doesn't, I won't waste anybody's time with setting up meetings that won't go anywhere. So anyway,
Yeah.
lots and lots of great places, but those warm intros are the best.
Yeah, no, I couldn't agree more. And leveraging LinkedIn to find people who know the right people and who can get you those warm introductions is super important. Elisa, how about you?
Yeah, so since we have an accelerator model, about 75% of our deal flow does come through our accelerators, either current cohort members that we invest in, or in many cases, alums of our accelerators that we go back to and invest in later as well. And because of the way our model works, we're in multiple cities all around the US, and we actually connect with anywhere from 50 to 100 different community groups on the ground in each of the markets where we have our accelerators. Those can be groups like other incubators, other academic institutions, networking groups, that focus on founders in various ways. We focus on a lot of groups that do focus on DEI, either women founders, founders of color, and we'll connect with all those groups on the ground in those different locations. And we built those as longer, deeper, long-term relationships. So not only do we use that to then source those deals for our accelerators, which we then, invest in a small selection of, but then we also use those relationships longer term, where we've really built up these little mini ecosystems in each of the places that we've been, so that we have a lot of folks who are sending us ongoing deal flow from those different regions. So we build kind of longer term relationships in each of the regions we serve. And then we also, of course, invest in some of the best companies that come our way through those different ecosystem channels, that maybe companies that don't go through our accelerators for various reasons. And then finally, we have an open application process on our website. We do that very deliberately. While of course we get some great introductions from our networks all the time, we also like to make sure that our application process is accessible as possible to as many people as possible. So we do that very deliberately, so that we can, just get folks who might not have all the connections to get to us through a warm introduction, but really are a fit for our thesis, and they can just apply cold from anywhere. And we do look at all of those applications as well.
Love that. Okay, great. And then we can share links to all of this to the audience as well, with respect to, all of your different sites and where folks can go to get on your radar. What specific criteria do you consider when you're looking at a potential investment? Like, how do you determine the growth potential of a company as well? Let's start with Peter this time.
All right. Well, this is one of my favorite questions, because my answer is usually different than most other people's. And I have just one thing that I look for, so it makes it really simple. And the one thing I think that investors should be looking at is, what's the exit strategy? And a lot of times there's a lot of confusion about what an exit strategy even is, or what it means, or does that mean the founder has to leave, or whatever. And there's sort of a lot of mythology and misunderstanding about what an exit strategy is. So, of course, most people will say it's the team that they look at. And of course, the team is one of the most important parts of an exit strategy. But instead of just having a bunch of PhDs and MBAs, or people with industry experience, or, meeting other criteria that you've got, the idea of looking at the exit strategy is to look as much at psychology as at markets and finance. And so I will look for certain keywords that I'll see, or phrases or attitudes, to understand how founder is thinking about their exit strategy. And the things I want to know about what they're thinking is, do they really understand where their industry is going, so that they can fill a gap for the incumbents in that industry in a period of about 5 years? Because if it's just about today, then they've already lost the game, because they're not going to exit for quite a while. And 5 is even optimistic these days. So I'll look for that, and then I'll look backwards. I'll look at who is acquiring whom, and who, do they really match the profile of what these people are looking for. And then I'll look at timing. What do they have, like early, mid, or late exit opportunities? How would I evaluate, and more importantly, how would they evaluate when they want to exit, or when they will think they will hit the top of their growth curve, and when they want to be acquired? So, and then of course I'll do an analysis of who the acquirers would be and why they might actually acquire this company. So all of those things, of course, deal with, the product, the market, the finances, and all of that. But it's also the psychology side. And are we aligned on where we're going? And are we going to be partners in this or not?
Yeah. Okay. That's great. Desiree, what about you?
Yeah, it's a great question. So part of it for Josephine Collective is that we have a group of angels investing together. So we definitely look for things that will be, easy for the group to understand and see the market opportunity without having to do, a ton of diligence, because we're not a proper fund. We are, an angel group. But I will say that we filter for quite a few founder and market attributes. One is definitely around growth mindset. And that is demonstrated often through how obsessed they are with the problem rather than their solution. And I know that we all say this over and over again, and then we still meet plenty of founders who are so obsessed with their solution that they miss some of the other opportunities. So we try to filter for that. We also do pay a lot of attention to competitive landscape. And is this opportunity, or is this version or solution a meaningful upgrade from the incumbents that are out there or any of the other deals that we see that are, activating in the space? A lot of times founders do a great job of saying how they're different than the big player that's been around for 20 years, but they fail to do some of the research around the other up and coming startups. And so that's one way that we can kind of unfortunately filter people out when they haven't done their homework on that. And then we also like to see what key insight they have that's going to make the business stand out or accelerate past this, the many, many hurdles that early stage founders have. So there's something about the macro trend that is going to be in their favor. Is there some way of navigating headwinds that the others haven't figured out? So really looking at people who've been thoughtful about the build and the next steps of the business. And then the final piece is around, are they raising the appropriate amount of capital right now to hit the next milestone that indicates product market fit? And that's honestly where a lot of founders fall short. And so we at Speed Round, like one of the programs that we run at P33, really try to help founders figure that out. And some of it's industry dependent, some of it's around, what comparable or analogous companies have done over the last few years, but sometimes it's just about figuring out the cost of acquiring the next 2, 3, 4 customers and whether or not they're going to get enough data from that. So I'd say those are the key things that we look for right now.
Okay, great. Elisa.
Yeah, I'll talk here a little bit about our core values because that applies both to our team as well as to the founders that we work with and seek for our portfolio and our accelerator programs. The first is conscious inclusion. Of course, we talked about our gender and diversity lens, and we're also looking for teams that are building out those diverse teams themselves as well, and really thinking about that also in terms of who the populations that their company serves as well in many cases too. So it also can be the markets that they serve as well. And then heroic persistence is next. We all know that we really like those founders that have that grit and persistence, right? It's such a key ingredient to a successful company, is just oftentimes being able to fail multiple times until you succeed. And then lifelong learning. So we want those founders who are both experts in their field, but also who are constantly growing and evolving. We know that this is a space that changes at light speed constantly. Original thinking, and of course, like that innovative approach and sort of a unique way at looking at a problem. And then an ecosystem approach. So for us, this is critical. This is those founders who will go on that founder to funder journey and who truly are lifting up others in their community, even while they're building their businesses. And then finally, a scalable mindset. Of course, those founders need to be able to think of something that can build much, much bigger beyond themselves, right? And truly be a venture scalable kind of company and a problem that's big enough that they're tackling, in a market size that's big enough that they're tackling. That, of course, all spells Chloe's. So we do refer to our founders as Chloe's as well. So that's an easy way to remember our core values.
Love it. Love it. Love it. Okay, great. Let's go into some challenges. Now, we know that it's difficult raising money and companies need to get prepared and all of that. Can you talk about some challenges that you've seen founders endure and maybe how they could have prevented it? Let's start with you, Elisa.
I like to talk here about this concept of founder-funder fit, because really it's all about finding that right match between a founder and that potential investor. So a lot of startups will, of course, take that approach where they'll try to raise funding from any investor that's out there. Peter alluded to that earlier, and that those kinds of cold outreach. And Don't get me wrong, I don't have anything wrong with that. I know that there's a lot of founders who maybe don't have those networks to start out and oftentimes need to take a cold outreach approach to begin with. So so I don't have any judgment on that per se, but I will say that, of course, it does end up not being perhaps as strategic, right, an approach, or as efficient an approach as it can be. So when you think about founder to funder fit, you're thinking about what those investors' thesis is and whether it aligns with your company. So each of us on this call, for example, went through some of the elements of our thesis, right? Like as I gave you mine, I kind of bulleted it out in terms of, geography, sectors, textiles, stage, all of those things. All of that makes up an investor's thesis. And it's really important that if you have that time, you can do that research where you really qualify the investors that you're going after to see what their thesis is and how well it matches up with your company. And you're going to save a lot of time and have a much more efficient approach. So you can do that research ahead of time and be able to really identify those funders whose thesis does align well with what you're building. There's a lot of other things to think about as well. There's so many different types of funders out there, right? There's funders who are philanthropic. There's funders who are, who are looking at as angels, looking at from a very personal perspective in terms of who the relationship is with. And there's also, funders out there who are investing in all kinds of different types of businesses. So part of it, you want to think about what type of business are you building, but also what is your exit strategy? Like, are you building more of a Main Street business, or are you building more of a venture backable business? Because there might be different types of funding mechanisms like loans and SBA offices. If you're looking to build maybe more of a local services business versus a VC business, VC funding really isn't a fit for everyone. It's only actually a fit for a small segment of companies, even though it gets so much attention in the media, right? So, be sure to think about what kind of company you're looking to build and what types of funding mechanisms might be a great fit. There's a good book by Jenny Kassan that talks about raising capital on your own terms, that actually looks at some of those alternative models for companies that are not a fit for the venture model. There's also one of our portfolio companies called $1 Million Women that also focuses more on those companies that are those more Main Street businesses that are, still looking to really scale up their company, but maybe not with a venture model. So there are other resources out there that can help those types of companies that I really recommend, checking out as part of your journey as well. And then finally, just really developing a very good qualification process, right? Where you basically have, someone on your team, either you or maybe an intern or someone that you hire, who basically ends up helping you qualify those investors and finding out if the timing is right, if their check size is right. Keep in mind that many funders are also raising capital themselves. So the timing isn't always right. Even if they're out there, they might not always be deploying capital. They might be in between funds. That's something that happens a lot, right? We're in that place right now. We're sort of in between like a fund one and a fund two. So when you're in those different fundraising cycles as a VC, you may or may not be deploying as actively in those phases. So that timing is really critical to think about as well. And that should be part of your qualification questions as you're looking at qualifying your funders as well. So those are a few tips.
Amazing. So great. And yes, you can waste so much time looking for the wrong type of investors. So, do your research, do your diligence, and then if you can leverage your team, even better. Peter, over to you. What challenges or common mistakes have you seen from folks raising money?
Well, of course, you could write a book on this or two. There's a lot. And I'll just sort of give a couple of different perspectives and try to be quick about it. But one is a lot of the people we're working with have extraordinary challenges, ones that all startup founders don't have. And so those are, Black and Hispanic women, rural, Montenegrin startups who are in places where capital doesn't exist, where models to follow don't exist, where mentors don't exist, and friends and family don't exist, or at least friends and family who can fund you like other startups would have access to. So all of those things sort of take an entire class of founders and put undue weight on them. And I have to say, over the last 5 years, I've been really excited to see so many new programs, and we're seeing them here. But so many new programs. The EDA, Economic Development Administration, is supporting underserved founders in so many ways. So that's one, is just to seek those things out, because there's probably more than you know about. If I look at what was out there 5 years ago, there was just a handful, and now it's really awesome. There's just so many different things to choose from. And over the last 2 or 3 years, the data has shown it. So the investments in women, Black, Hispanic, and rural founders have all been on the rise. And so this is really a source for optimism. And then I'll say, just for all fundraisers, one of the challenges I think is just you've got to go super fast. This is a fast speed-based thing. So if you take too long to raise, your raise will die. If after you raise, you don't go fast enough, you won't raise your next round and your company will die. And so just thinking about speed is important. And so my advice to companies who are, facing this need for extraordinary speed while also facing extraordinary uncertainty and having to make all of these incredibly complex decisions is to always be planning, like you would in a chess game, 2, 3, 4 moves out. And I think the one failing I see of most startup founders is they're really excited about their solution, as we discussed earlier, and they're all about that. And I just need $1 million, and I'm going to take this, and everybody's going to buy it, and it's going to be great. But I would rather see them take a little bit of time and think about, well, what's the next move and the next move and the next move? And how am I going to overcome those things? And you can do a lot of that strategically without the expense of doing it in the actual market. And so that's how I think that the companies I see be really successful are thinking like that, thinking way ahead.
Yeah, no, that's great advice. And you're always going to run into roadblocks. So those that you can anticipate and plan for, the better off you're going to be. That is for sure. Desiree, what about you?
So having done fundraising the wrong way and the right way, I know I've raised about $11 million for the 2 businesses I ran, and then probably another $8 million for the projects that I now run. And which is, in the grand scheme of things, not a huge amount of money, I will admit, but they were slogs. And I think a mistake that I made back in the day that I see so many founders make now, well, it's really 2 things. One is that some early positive indicators of interest from certain investors can sometimes derail your process. And so you think like, oh, I'm in data room with this firm and they really like it, but you don't really know until the check is signed. And so you need to be working a process with many other potential investors. And so during speed round, one of the things that I teach is this like intense process, to Peter's point. Like treat this like a sales cycle, just practice almost for the sales cycle you're going to have for your own business. And you have to create these concentrated moments of time where you're doing certain activities on repeat to create some just kind of fluency and consistency. And so it requires a lot of discipline, and it requires putting other things away and down. But basically taking 2 weeks, and I don't mean like 2 weeks where you say you're doing it, like actually 80 hours of building your lead list, where you're using tools like Crunchbase and Signal and others to qualify the leads, to understand if there's any competitive businesses already in the portfolio, to understanding who your intro paths are and starting to ask for those intros. And then taking the 3 weeks after that to get all of your first meetings, with the goal of having somewhere around 40 first meetings in a 3-week period. If you do that, you can often convert about 50% into a second meeting. And that's when you know if you have people that are interested and can get into data rooms. And the founders who follow that process, or a version of that process, oversubscribe. And the ones who take 6 months to do it, the rounds fall apart, they raise too little, and they're constantly undercapitalized. And so putting the time and work in upfront can really make a huge difference. And then even when you have someone in data room and you're excited and they're excited, you have to keep dating, because you just never know what can happen.
Oh, isn't that the truth? And that is such great guidance. I love a good process. You know me, I love processes where we can delegate and make sure that things are, happening in a short amount of time. That's awesome. Melody, what about you? Melody could write a book on this topic as well. Tell us about some challenges that you see founders face as they're raising money.
Yeah, so I think I'll piggyback a little bit off of Desiree. I think ultimately fundraising takes a lot longer than anticipated. It requires significant time and resources, especially from a startup. You need to plan for delays and allocate those resources to support the fundraising process. It's like a full-time job other than the full-time job. And, honestly, failing to do so can just strain your operations and impede business growth. So that's one. The second is just overlooking everything legal. Everybody just starts off, runs. You're not looking at your organizational documents. You're not looking to see who needs to vote on things. You're overlooking securities. You're overlooking, really contractual areas as well. And then oftentimes skipping professional legal advice, and coming to legal after the fact, which isn't ideal. So I would just say, start looking at everything as early as possible and make sure that you're allocating the time and resources needed to fundraise.
Great, thanks. All right, let's talk about the investment landscape and let's talk about what that looks like for the audience. Are they going to be able to raise money quickly, or how's that going to look nowadays? Elisa, can you kick us off with that?
Yeah. Sorry, Tricia. That was a question about the landscape, correct? Sorry, I was just also responding to
Yes,
some
that's
questions in the
correct.
chat here as well. Yeah, in terms of the current fundraising landscape, you know, it's funny because people obviously pay a lot of attention sometimes to, oh, you know, this is kind of the market has, you know, shifted in this way or that way. And it's been our experience when we're out there fundraising, for example, you know, as fund managers as well, that all of the markets have their unique, you know, opportunities and challenges. Like when we started fundraising, I'll just give a few examples, right? We started fundraising in the middle of the pandemic, then we had multiple wars happening, and we had various kinds of other market conditions going up and down, right? We have markets shifting from equity and debt and back and forth, and, you know, all kinds of different things happening, right? So in terms of all those macro trends, we've just found that no matter what market we're in, we're always facing certain kinds of opportunities and certain kinds of challenges. So the way when I look at these kinds of landscape questions, I really think about it as you got to follow a lot of the same best practices, and you've got to end up kind of going out there and putting yourself in front of the right folks either way. And there's always funding out there in any market, right? It's just a question of finding, again, what that founder funder fit is. And that founder funder fit might vary in different markets, right? So there's different types of people looking for different types of opportunities, different companies and firms looking for different types of opportunities in different markets, right? So a lot of it is, again, kind of aligning with timing as well as with the right funders in those different time periods. So I would go through that same kind of qualification process, that same founder funder fit process, and just vary it a little bit based on different market conditions, if that makes sense.
Yes, absolutely. Peter, what about you? What's your perspective?
Well, I'll say it looks like just about the toughest environment for raising money in the last decade. So, you know, when you see what's happened, actually, if you just look back over the last 4 years, you saw sort of growth, and then craziness in 2021, and then coming back down in 2023 as interest rates rose and we were, you know, battling inflation. And then if you look at where all the capital comes from the institutionals on down to angels, everybody was kind of tightening up because of extraordinary uncertainty with the economy, and of course the cost of capital and the alternative places that people were putting their capital, as opposed to, if you think about the risk reward ratios. So that being said, so that's the dark side. Sorry about that, but it is, and we're down. I don't know what the latest number is, but something like 40% over a couple of years ago. So the amount of investment, the valuations, all of the number of deals being done are all decreasing. And of course, the other big thing, it's not just interest rates, it's also that the exits are on decline. So IPOs are not happening, and M&A transactions are fewer and farther between and smaller. So that, of course, means longer time to exit, and that, of course, affects the IRR and how investors think about things. However, I think investors should be thinking, this is the time to come in. This is when, you know, valuations are down and when you can help companies. And I'll say I've been very frustrated with some of the companies in my portfolio who have used the down economy as, actually, the economy is doing great, just to be clear, but they've used the down investment environment to as an excuse not to pursue fundraising, you know, with tenfold energy that they would have, you know, earlier. And I think there's money out there for people who work hard, who have a good story, who can execute on their plan. And it's just frustrating to see people who don't do that. And we've had a couple companies fail over this last year. I think they didn't need to fail. I think they kind of, it was harder than it was last time, and they gave up early. So don't do that.
That's
my
rough.
advice to startups.
Yeah.
Keep it going.
Okay, great. And then Desiree, what about from your perspective?
Well, I'm going to share a positive trend that I think maybe people might not know that much about, and that is that there is an opportunity, or an increased opportunity, for values-aligned investments to target donor advised funds for alternatives. And it's not happening like at a crazy amount, but I'm seeing more and more startups that are coming through Josephine Collective, and I'm definitely seeing it on the GP side of things as a strategy for activating capital that hasn't previously engaged. And it's more risk tolerant capital. So, industries that might take longer to pick up, or ones for founders who, identify as an underrepresented class. I do think that that is a window of opportunity that's just being opened. In Chicago, we have about $5 billion sitting in donor advised funds in our Chicago Community Trust alone. And that doesn't include everything that's, high net worth, has that Fidelity and some of the others. So if you have, a pathway into family offices where a donor advised fund is an opportunity, I would say experiment and explore with that. And the other is family offices. So, there is a generational wealth shift that's happening right now. A lot of younger generations are more values aligned in their investments. And, the bigger family foundations are harder. There's an investment team, they have an endowment. Their job is to amplify that endowment as much as possible. But the smaller family foundations, I think, are an opportunity for you to get local support that is probably more patient. And so it's hard to make those connections. And I'm not saying that it's an easy path, but I do think it's a new and growing opportunity.
Amazing. Awesome. And I know we're coming up on time here, so I'm just going to end with this last question for each of you to answer. And that is, what is your best piece of advice for companies raising money? Desiree, let's kick it off with you.
I would say to really run a tight process, have the discipline to do it the right way early so that you don't end up extending forever and not raising what you need to, and then really failing because of a lack of process. So, if you need to talk to someone who's in enterprise sales to give you advice, or you already are great at sales, you just need to have the discipline, find someone that you can be accountable to and have the rigor around your process. And the other is, there's 4,000 venture funds now in the US, and the vast majority of them you probably have never heard of. And they're looking for diamonds in the rough because that's how they're going to make their multiples and how they're going to get the next set of LPs excited. So think about where that alignment is with these up and coming emerging fund managers and new funds. And there's so many that are highly verticalized in industries that are relevant to you. So as much as I love the big guys and those names are amazing, I would go to the smaller guys across the country and look for a really great partner. Yeah, that's really great advice. Peter, what about you?
Well, I have one main theme, and that is this is all about relationships. And a lot of people come to me on a Wednesday and say, Peter, I have this great deal and we're closing on Friday. Are you in? And the answer is no, it is not. Who are you? And so I think a lot of founders, when they're focusing so much on building their market, building their product, building their teams, and it's such hard work. And you have to remember to always be building your future investors pipeline. And that is something that takes 6 months to 12 months or more to get done. So I always tell people, as soon as you close your first round, take the weekend off. And on Monday, start closing your second round. And I don't mean closing it. I mean, reaching out, and letting people know what's going on. Some people give quarterly updates to their investors, and that's awesome. Once they get investment, others don't. Shame on you guys, by the way, because they're not going to do the next round. They're like, who are you? So keep the quarterly updates coming, but not just for the people who wrote you a check. Keep them coming for the people who didn't write you a check. Because for us, I don't know, half the time when we say no, we aren't really saying no. We're just saying not right now. We need more traction. It's not right for us now, or just timing, as mentioned earlier, all of these things happen. So keep sending out those quarterly updates to build your list, get it bigger and bigger and bigger. And I bet you a lot of those people who you keep in contact with will work out. Last thing about the relationships, exits are all about relationships, and exits take even longer than a round. So I think the first year you start your company, you should start talking to the people who are in the companies who you think might be your acquirer and build those relationships. Believe it or not, they know what you're doing. So it's not a stealth thing. Better to have them know what you're doing. And then when they've got a strategic need, they'll know right where you are.
Awesome. Love it. Great tips. Elisa, how about you?
Yeah, my first tip will definitely echo that of Desiree and Peter, and that obviously staying in touch and that persistence is so key, right? So the regular investor updates and just knowing that you're going to hear no a lot of times before you hear yes, and being ready for that. and ready to not give up in the face of that. When we're fundraising for ourselves, even, we hear oftentimes 100 no's before we hear a yes. So it really takes stamina. And so that's something that can't be underestimated. My second piece of advice, really, it comes from our core value, which again is about founders who uplift other founders. So really think of how you can give first in your ecosystem, in your community. How can you help another founder with their fundraising? That kind of give first and sort of community oriented attitude and that sort of ecosystem building attitude will really come back to you and come back around to you in some really positive ways. So our advice is always for founders to uplift others and think of ways that they can help each other.
I love it. And it's so true. We all get so much further more quickly if we all just help each other, 100%. Well, thank you everybody so much for joining. I really appreciate your guidance, your wisdom. I'm sure the audience does as well. There's some comments here in the chat. If we didn't get to your question, we will follow up afterwards. Thanks everybody for joining and have a great rest of your day.
Thanks for having us.
Thanks for having us. It was great.
Bye.
Bye.